Well, good morning, everyone, and welcome to this webinar on how to prepare for startup fundraising. And with me, we have a very interesting and a very renowned and a very empaneled panel, I would say. And we have with us John Kuruvilla, and we have Shibam, and we have Sanjay Mehta. And I want to say a big hi to all the participants who have joined in, and we had a look at the participant registrations that we had, and I think we have five set of people who have joined in, and these would be startups. That has been the majority, and I think close to 60% of our audience would be startups at an early stage, or who are planning to raise their first funds, or who are who are already in talks with investors, or who are already in scale up stage. And secondly, we have students, somebody from through SINE IIT Bombay. We have reached out to the IIT Bombay community as well as to the other universities, and we also have faculty members as well. I saw some faculty members wanted to know more about startup entrepreneurship and fundraising. We also have colleagues from various incubation centers across India, and we have apart from incubation centers, we have accelerators and other tech transfer offices, people joining in from there as well. And also we have people who are also curious to know what startup fundraising is all about. And so we have five set of people who have joined in. So before that, I'll do an introduction. My name is Rakesh, Rajiv. I am part of SINE IIT Bombay, which is SINE is Society for Innovation and Entrepreneurship. We are IIT Bombay's Technology Business Incubation Center. And we have a rock star panel, I would say, meaning we have investors as well as entrepreneurs. And all the panelists who are here are entrepreneurs and also investors. I would like to start the introduction with Sanjay Mehta. He is founder and partner 100X.VC, and his profile as the most active angel investor by VC Circle and Inc42, and he's invested in 130 plus companies, and he was the early investor in Oyo Rooms and Block One, and 2 unicorns in his portfolio. And he has been a Thai board member for over 3 years before founding 100X.VC in 2019. So 100X.VC, through 100X.VC, he's bringing the revolutionary iSafe note, and Sanjay would explain what iSafe is, what it is, in later on in the panel. Next, welcome Sanjay.
Thank you for having me on the show, Rakesh. Thank you.
Next, I would like to invite and welcome John Kuruvilla, co-founder and CRO of Kalpnik Technologies. He's also an angel investor, and through Kalpnik, they plan to revolutionize the way people experience remote places and events virtually using VR and AR tools. And John has 30 plus years of experience in across various domains ranging from real estate to aviation to hospitality, and he has raised over 150 million of funding in his entrepreneurial career. And in his corporate career, he's been part of Air Deccan, Oberoi, and Reliance Geogen Next. In fact, he was the founding managing director of Reliance Geogen Next. Welcome, John.
Thank you, Shibam.
And thirdly, we have Shibabrata Das, and he is the co-founder and COO of Atomberg Technologies. He is also IIT Bombay alumni and also a SINE alumnus as well. He is a graduate company of SINE, and he's also a recipient of Forbes 30 under 30. At Atomberg Technologies, they make what is called as Gorilla ceiling fans. You can see Shibam's t-shirt with Gorilla written on it, and they manufacture India's most energy efficient ceiling fan, based on the proprietary technology using BLDC motors. Well, the value proposition they have is it consumes 65% less power as compared to ordinary fans consuming more power. So cost effectiveness of 2,000 to 2,500 per fan is their value proposition. Welcome, Shibam.
Thank you, Rakesh. Thank you so much for the warm introduction. We'll look forward. Yeah.
Right. So so we through the webinar, when we had the registration, we had multiple questions. We will try to address most of it. I have tried to pull it down to different questions. We will address that. But first, to start off, I would like to ask the first question to Sanjay. Sanjay, you have invested in 130 plus companies, across multiple domains. And while you are investing, what is that you look for in a company at an early stage?
So typically what we look across is what founder's vision is about what is the future which he is looking into, what is he trying to work upon. See, what we are very, very bullish about is on the moonshot ideas, anything which has got an impact, anything which can be really game changer, or trying to build something which is going to create a huge impact is something what we would try to look upon. While having said that, at early stage, because the founders don't have enough data to prove themselves, what we go across is first trying to look at whether this is a great market opportunity. Is there a market size availability where it can take a lot of VC investments into the business? Second, we look upon the founder's right to win. What is the expertise that a founder has? Third, we look at the business model strength, right? Is there a path to profitability? Does a founder make money? Fourth, we look at unfair advantage and the moat. What what is it that this company can have a moat about, right? And lastly, the fifth one is our conviction that we as an investor will be able to possibly get 20x return by whenever we exit this kind of business. So this business has to be really scalable business, not that we know how to pick winners, but we just filter out startups basis on this couple of criteria where we are not looking at their financial past financials or revenue generating revenue generations. It's all about the future, right? Do they have the ability to create a large scalable business? So in nutshell, these 5 points are more than enough for us to take a decision.
Right. Thanks, Sanjay. So you mentioned that it is a founder's vision to start off with, and at an early stage, when somebody comes to you with, with with a technology or a startup idea, something which he has validated, at that stage, probably it is a lot on gut feel, right? How do you how do you kind of assess that this guy or girl is going to make it big, or that that person is taking that amount of risk? What would be the opportunity? How do you kind of assess that? It's more of gut feel. Even at SINE, when you incubate companies, a lot goes into gut feel. But are there ways in which that you look at the passion, you look at education qualification, or the team?
So one of the learnings is to create uh, uh, an insight, or I would say across that decision or judgmenting muscle. So given across when you have limited information, it is about your judgment what you will bring to the table, which will create this investment decision. So what we try to learn across is through our investment failures and successes, right? Having done investment last 10 years and now almost more than 150 odd companies, I would have seen almost like 10,000 plus deals. So what my journey has taught me is to take a decision basis on my understanding on all those data points which over in past history I've learned across, and that gives me that muscle to take that judgmental call, right? In terms of investment, whether this founder will work across, does this deal make sense? Will VCs invest in the next round? So that is where I believe it is all about the learnings which you come with in the past helps you take this decision. But in nutshell, three things typically an investor will look into in mind whenever, let's say, for example, a startup is going to present across and the unmet need, what kind of problem statement they are solving. So all their value proposition. Then whatever comes into my mind is there money to be made? Whenever founders talk about their team, their what are their learnings, their education, then the thought which comes across is, are these people who can make me money? And lastly, their business model, their capital requirements, their valuation, how much money I can make. So three things which typically ticks into any investor mind, and especially for me, this is worked across. Uh, is there possibility to make money? Are these people who can make me money, and how much money I can make, right? So this small and simple way, you take some decisions.
Great. Thanks, Sanjay, for that. Now, John, you've been, in your entrepreneurial career, you've been part of, you have started off companies, you've been founders at a few startups, and you also have advised startups, being part of accelerator programs, corporate accelerator programs. You have advised startups at different stages, and right from early stage to kind of scale up. So, for the startups who are part of this webinar, or those who are planning to start up, and funding is one thing which is something that they should be planning right from the beginning. So, what is your take on how to plan for fundraise, and how should startup prepare for it?
Thanks, Rakesh. I'll give you three real-life anecdotes, all that's happened in the past 3-4 years. There was one startup that was mentoring in the water management space. The company was doing a monthly revenue of 30 lakhs and growing at 10% month on month. And they came to me and said, look, it's time to raise money. So I tell startups to answer 4 questions. Why do you want to raise money? When do you want to raise money? What do you want to raise money as? Should it be equity? Should it be debt? And most people don't understand debt is far cheaper than equity. But startups have a problem raising debt from the market. And the 4th most important question is, who do you want to raise money from? So when this company said, look, we want to raise money because we are a hardware company, and we've grown to a certain level. We have orders in the pipeline that are worth 3 crores, but we don't have money. So the why was very, very clearly answered. They needed capital to actually grow their business by creating a supply chain that was geared to deliver to the unmet demand, that was created. Then I asked them, when do you want to raise money? They said, look, we have to deliver. We have money for the next 4 months. We have to deliver another 10,000 units in the next 6 months. We need to raise money now. Now, money raising is not something that can happen overnight. You need to plan at least 3 to 6 months out. In some cases, it takes 12 months. And then when we were clear on why they need money and when they need money, we said, how are we going to do this? First of all, we also need to understand how much money they need to raise. We actually spent a lot of time, almost a month, on working out a very, very deep and intensive business plan, which showed me not just money in, money out, but cash flow. Revenues in. One thing that people miss out is, calculating revenue is not a good idea. Calculating cash flow becomes that much more important. And then we realized that, debt was, so we went to the market, we went to a bank and said, look, can you fund this company? And they said, look, we can give you an OD. And the OD was enough to cover 2 months of demand, which is when we realized, let's go and raise money from the venture space. At that point in time, the decision was, should you go to VCs or should you go to strategics? Now, in this case, there were 2 strategics who were in the pipe business. And we said, why don't we talk to these 2 companies? And they liked the company, but they were not willing to take a bet as an investor, which is where one of their existing customers, who was also running a very, very large company, a 1,000 crore company, said, look, I will invest. And that's how this company raised money. The second story is of a company in the service space, again, doing 50 lakhs a month revenue, profitable. And profits, EBITDA of 32%, profit after tax of about 18%, they didn't need to raise money. But the promoter, because he came from a very renowned engineering institute, all his peers were raising money. He said, John, I want to raise money. So we realized that while the company didn't need money, the promoter, due to peer pressure, need to raise money. Again, we went through these 4 exercises, and finally that company also was able to raise money. But our advice even then was, don't raise money, You don't need equity. You can grow without this money, because they needed 10 lakhs to open a city and they had enough of that money sitting in the bank. The third case is of Kalpnik. Kalpnik was using AR/VR to disrupt religion. The minute I said religion, every VC checked out. Nobody wanted to invest, because VCs don't want to invest money in a religion space. A. B. International VCs didn't want to put money in a single faith business. So what happened? We said, forget it. Let's put money and let's scale the business. It so happened by coincidence, we met an investor in Delhi when we had gone to a temple. And he said, look, why don't you take my money? Now, that's a great space to be in. Somebody comes and says, listen, take money. I will give it to you as convertible. Give me a discount of some percentage. And that's how, again, even at Kalpnik, which is founded by three of us, we actually asked ourselves, do we need this money? If we need it, when do we take it? What valuation? What do we take it as? And who do you take it from? So these are the 4 key questions a startup should ask: why, when, what, and who. And there are different ways to raise money today, unlike where in my first startup in 2000, there was no VC. So I actually went to a strategic who was a real estate developer when I did my first startup in the prop tech space called PropMart, and he and I became partners. So I hope that answers that, Rakesh. Can't hear you, Rakesh. You're on mute.
Right. No, thanks, John. That was very helpful. Also, when startups, some of them are at a very early stage, right? So planning for cash flow, planning for pricing is one. Planning cash flow is another one. How much to raise is another important question, because very often what I've seen in startups at SINE is that they say they want to raise 50 lakhs. I said, why not 60 lakhs? Then they get confused and say, oh yeah, it can be 60 lakhs too. But how is that? Do they work backwards from where the runway or the amount of time they need of the money for by which they can see revenues coming in, or how much to ask for is something that many entrepreneurs are baffled about, or may not be putting enough thought into. So how at an early stage would a startup decide how much money they should ask the investor?
So very, very good question, Rakesh. Most times the startup doesn't know how much to raise, and they also do not understand their business model, because very, very early stage, so they don't know what revenues they can. They just know that they have a burn, and that burn, so which is where a good mentor comes in handy. And the mentor and people like Sanjay and I have seen hundreds of companies, and we are able to look at different buckets and say, hey, if you're in this space, in the service space, and you're disrupting something, you will need X amount of money for the next 12 months. And at that point in time, we add a buffer of a 20-30%, say, look, you need a runway of about 12 to 18 months. And that's how you work backwards and say, perhaps this is a good amount to raise. And that's where this judgment call that a good advisor can give you actually works to the advantage of the startup who's just focused on building a great product or solution.
Thanks, John. Shibam, you've been part of Atomberg Technologies. You founded the company, and you have a very interesting journey. Right from at the time you were at SINE, you received the initial seed funding from us, and then you raised the angel investment, and then you moved to a pre-Series A and a Series A recently. How did you? Can you share with us your story as to how did you choose the investor? How did you choose the right investor at different stages in your company? Starting from the time you are, I think you have a pivot story as well. You plan to do something, and then you realize that this is what the market need is, and then you focused on that. So, how did you find the right investor who believed in your vision? Because this is something technology linked, which can increase the efficiency that is disruptive in the market. When there are a lot of fan companies out there, how did you convince the investor? And take us through your journey on right from the time from angel to pre-Series A to Series A.
Right, Rakesh. Thank you so much. The question that you asked, like how do you choose an investor? But Fortunately, unfortunately, startup founder doesn't have a lot of time choices to invest, to make an invest, to choose an investor. So that means there are two cases. On the first case is that when you don't have any choice, that means whatever pitch you make, whatever business model you present, investors are not showing interest. This is one scenario. Second scenario is where investors are showing interest, and you have 2 or 3 investors to choose from and to select from. Then how do you choose 1 out of 3 or 1 out of 2? Fortunately, unfortunately, I had experience of both the scenarios. Let me explain to it. The first case, so in my first startup, there was an e-commerce startup, 24/7style.com, where we raised 1 crore, probably just in 1 or 2 meetings. And what I realized is that the decision to raise capital from that particular investor was not right. So what we mean by that is that in first scenario, when you don't have much choice, the best thing you can do is to not raise to not raise money from a wrong partner. Now, how do you select a wrong partner? How do you define a wrong partner? There's no definition of right or wrong partner. There is no standard format. But if you remember, there was a serial called like this Pictures by TBF, where there was a bhujia wala who wanted to fund their startup, right? And we all, as an audience, knew that investor was not right. Similarly, you got a gut feeling, right? So whether the person is understanding your business or not, whether they're aligned or not, and if you think that the person is not right, and you don't have a choice to make, then you should just try to somehow increase your runway to the extent possible. Of course, beyond a point you cannot extend it, and then you'll have to raise money because there is no point in dying and to not raise from any investors. So that's the first case. On second case, let me share my journey of raising fund in Atomberg. In Atomberg, we raised 1 crore from as an angel round after SINE incubation, of course. While raising that 1 crore, I hardly met like 4 or 5 investors. Hardly spent 2 or 3 months, and one out of them got convinced, and he immediately pitched in 1 crore at certain valuation. It was a very easy round for us. Then we raised another pre-series A round, kind of like close to $1 million amount. Now, again, to raise that round, I had to spend around like 15-20 meetings. Didn't take more than 4 or 5 months. And fortunately, at that round, I have an option to choose because there are 2 investors who showed interest at that point of time. Now, just to give you some perspective about 2 types of investor that I had to choose from. On one side, there is one investor who was pretty new to the entire VC ecosystem. They just started their fund. I mean, we were just the second of the investment, or probably the first one. They offered an amount which is close to $1 million, which we required, and the valuation was like 20% lower than the other investor, who also is a very, very premium investor. When it's a premium, like they're here, I mean, they're like tier 1 kind of investors. I will not take the name. Now, how do you choose? On one side, you have an investor who is very new to the system, who is offering you a term which is 10%, 15% lower than the investor who is offering, the investor who is already a tier 1 kind of investor. Now, if I just remember my discussion at that point of time, we spoke a lot of mentors, we took advice from multiple people. One more fact is that the second investor, that is the premium investor, they offered us the deal after we signed the term sheet with first investor, and we are already in the diligence process of 15-20 days already passed. However, that cannot stop us to not take the second offer. Of course, there is some morality, but if legally you are not, you can always, there are some like workaround. Now, at that point of time, there were 3-4 factors which we considered. One was definitely the valuation, the deal, the brand name, then the partner, whom you are partnering with. Both in both cases, in case one where the investor was new, we already built a repo, right? We already knew that whether that guy was aligned to our vision or not. And what we realized is that even if the second person who has a better brand value who was offering us a better financial terms, we realized that maybe in terms of business alignment, the first one is more relevant. And we actually went ahead with the first one, despite the fact that there was a very, there was the financial offer was definitely not as lucrative as the second option. If I look at hindsight, whether the decision was right or wrong, I will say the decision was definitely right. With a regret, the regret is that I could have probably renegotiated the deal a bit, and maybe we could have made it more sweeter for us, but that we didn't do. So that was a regret. But in terms of selecting the partner, I think we made a right decision, because after that, it took us another 3.5 years or 3 years probably to raise another round of capital. And in these 3 years, we made so many pivots. Like, we started with one business model, then it didn't work out. We went to the second and third and fourth. So we found at that point of time that maybe the investor one was more relevant, with more patience, in line with what we wanted to achieve. Whereas if I look at my advisors, mentors, everyone suggested that you should go ahead with a better deal and a better brand value. But somehow I got a gut feeling that maybe that was not the right decision. I think I was right at that point of time. And that definitely helped us. Now coming to the last round, where we raised around like $10 million from I-91. This round, we thought that, we raised first round in 1 month, 2 months, second round in 4, 5 months. Maybe this will lead in 6, 7 months, 8 months maximum. So we started like with 9 months runway kind of thing. And actually it took us almost 23 months to raise capital, from the third investors. And in this journey of 23 months, we like received 2 or 3 term sheet. 1 or 2 of them actually have withdrawn their offer after going to diligence round. We have seen almost near-death experience like multiple times. And again, fortunately, while raising capital from them, we again got an offer and an opportunity where I had to again choose between 2 investors. Now, taking the learning from my last round, definitely this time we renegotiated the deal a bit in our favor. But again, we never, like gone into the bargaining process, right? So you should definitely negotiate if there is an option to negotiate that, but you should not hard bargain. This is giving A, this is giving B. Let's do 2 and 2. So that doesn't look good. Secondly, in this scenario, same. There is one investor. Though N91 is a very big name in terms of their like partner profile, the other investors, they are like, again, tier 1 investors. They are ready to give a higher valuation, whatever valuation you quote. They're desperate to come in, right? In this situation, what we realized is that we analyzed and we took decision based on 3 parameters. One is definitely the valuation, whether the second guy is giving us like a similar valuation of what we offered, what we're expecting. So we got that commercial deal. Second one was the alignment with the partner, right? Now, alignment with the partner means we need to realize that we are not partnering with a VC fund. Most of the time, we are partnering with that investor who is coming on your board. So that person, that individual person, not the brand name. So whether you are aligned and whether that guy can add value to your business or not. In our case, we realized that the A91 guy, that they have seen this kind of businesses in past and they can definitely add value. So we respected that. Third was, since in this round, we have seen that it took more than like 9 months what we expected to raise capital. That means you need to partner with someone who can fund you if there are some uncertainties. Just for example, this pandemic. Now, this pandemic is no one can imagine in their business plan. But because of that, a lot of companies are already in stress. So in those scenarios, if your investors has some money left for you, it just comes in handy. So you need to always look whether they can give you a bridge round or not. And so these are the 3 things that's more important for us. And of course, the valuation part. So in short, in summary, if I look at this way, this is very, very, very important that you should have an aligned board. And when I say aligned board means an investor should be aligned with the business plan. There can be changes, there can be pivot, but if both of you are aligned on day one, it will definitely be a very easy and smooth journey. Just to give you an example, when we raised A91, so for example, we are a consumer brand, right? Our business model was that we go deep into one product and build our distribution, offline distribution. The other investor, he was more into, let's not go into one product, more distribution. Let's create multiple product and build an online distribution, right? Now, these are two different strategies, but we are more aligned with investor one, and hence we went with the investor one, right? So it is very, very important that you should have a board that is aligned. Second is, valuation is important. Commercial deals are important, but you should not bargain too much. You should know where to stop, and they should not feel like you are just trying to bargain from A and B. It's not like that. The third important part is that whomsoever you partner with, they should have enough capital to support you if there is an uncertainty in future. And the fourth most important part is that as I said, the board has to be aligned, and if the board is not aligned, then there is an issue. So this was my 3-4 learnings that we when we raised how to select an investors. I hope that answered your question.
Yes, indeed. Thanks for taking us through your journey. I think those 3 to 4 points which you said in terms of the alignment and the valuation bit, and to make sure that you have the right board to support you and to align with your strategies, I know that has been very helpful. And thanks for sharing that journey with us. And it also took me to the last question which I had with John, that how much to ask. That is really the key, that you should have a good mentor or an incubation center. A lot of people come to at SINE also. When they come to us, they see the value that any incubator for that matter and the team that provides. So I think the mentorship, understanding the people that you work with is very important while you fundraise. Now, Sanjay, during the investment process, once we finalize the term sheet, the next process is usually a due diligence process. Doing a background check of the entrepreneur, and also the entrepreneur. Ideally, the entrepreneur should also do a background check of the investor as well. From an investor's perspective, how is the due diligence process usually conducted, and how long does it usually take?
Sorry, Rakesh, my computer just got, can you just repeat it?
Right, I was asking, how do you, as an investor, would go on in terms of due diligence, and how much time does it usually take for completing the due diligence process?
So at the stage where we invest, we are a first check investor. So the process, what we do across is, when we get a pitch deck, we ensure that we go through the whole pitch deck. And once we like the whole idea basis on the pitch, what has come to us, we'll try to schedule across Google Hangout. And before that, we'll ask them before that Google Hangout meeting, we'll ask them to fill up some data points which we believe are missing across. So we will ensure that that data is well covered, and ask for a video pitch from those founders. And then we end up having them, giving us insights from the Google Hangouts. And this journey takes back and forth at least around 3-4 times, and takes anywhere around 2-3 discussion points. And then we ask for reference points, check across with their connect, saying that is this a genuine founder, just getting a dipstick on them. Many times we even go where we check the CIBIL score of the founders, right? What is their attitude over finance, right? Are they and as it is, there is not enough data available, because these are very early stage startups. There is not much of data. Then we ask across basic compliance details and data. But from the business side of it, we would like to talk to some customers, if there are any, or try to understand, take the demo side of it. And if there are some experts which we want to consult across, we'll go to them, saying that if this is an idea which we are evaluating, what would be your views? One of the major stuff what we do across in this whole process is run this deal through a couple of VCs, where we want to see if this deal builds up, would they be open to invest? That's our major criteria, where we would like to, because all these guys require typical size, some runway, some validation, and that's what we bring. At 100X is a pure discovery platform. We are a complete feeder to the complete VC ecosystem. So we come in first, we try across to ensure that we have done our validation, and once our validation does across, then VCs have much comfort in investing. And in fact, in our class one, out of the 20 companies, 11 were able to raise the next rounds, and 3 of them have raised from institutional VCs, while rest were family offices and angels. 3 got great institutional VCs, the best brands in the country and global even. It is a process which it's not a cookie cutter saying that this is how it would be, but definitely there are enough check boxes through which we will try to get ourselves comfortable. But once the term sheet is done across, I think more or less that intent to invest is always there. Otherwise nobody will issue term sheets. But after term sheet also, there are times where deal will fall through because of misrepresentation of data, or there is a gap which suddenly comes up and was not being covered across. Uh, we From our journey, as I always mention, venture capital is a 1% business. We ended up looking at 1982 deals, 1982 deals to invest into 20 startups. So it is a very rigor driven investment at the seed stage. So because our pool is very big, we have to really work hard in terms of pinpointing which are the businesses which we would like to touch upon. So that's in nutshell which we are looking across.
Thanks, Sanjay, for taking us through the due diligence process of an early stage startup. John, when startups approach investors, what is a definite thing that they should avoid? What is a definite no-no while approaching investors?
This is a very, very valid question, and I'll tell you why. When a startup, especially a young founder with an idea and nothing more, approaches an investor, it's a game of unequals. And I tell entrepreneurs, boss, please understand that the fact that you become an entrepreneur means that you are, in my eyes, a superior individual. So when you go to approach an investor, do not go as an unequal, go as it's a game of equals. A. B, if an investor, and these are my personal perspectives, if an investor or startup comes late for a meeting, and I don't mean 1 or 2 minutes, there have been investors who have kept startups waiting for an hour. I tell startups, get out and walk away from that deal. Because if a person does not have respect for your time, please do not waste your time. He will treat you badly even after he's put the money in. Third no-no for a startup is do not send unsolicited mails with your pitch deck through LinkedIn. Every day I get one deck from a startup saying hi. They don't even say my name. It's obviously a mass mailer. So do not do that. Do not give your business plan. Do not do blind calling and send out through LinkedIn's. That's the third no-no. The fourth no-no is, and we have had startups where the founder is desperate to raise money. When you're desperate, please understand a sharp investor will see through that. And if it's a good investor, he will not invest. If he's a bad investor, he will screw up the terms so badly. And I'll give you 2 examples. One startup that we mentored actually signed a term sheet with an investor, and the term sheet said that the startup founder and co-founder cannot take up any job, period. Any job. There was no timeline. Whether the startup shuts or does not, the legal agreement was so watertight, the promoters were slaves for life. They should have walked away from that. We had another startup where investor was going to put in 20 lakhs, but he wanted as a convertible and he wanted a 70% discount to the next round. And we told this promoter, please don't screw up your long-term for a short-term gain, because you're obviously here not to raise 20 lakhs, you're here to raise 20 crores. The next round will get stuck because this guy is only looking at short-term personal gains. So these are some of the anecdotal no-nos that I advise startups. For example, in one of my companies that I was raising money, we were raising $9 million, and we had got commitment of 50%. I went to this very, very big VC, and he told me as to how well he's done in life, how he's got a sprawling mansion, and he's got this. And in that half an hour meeting, 20 minutes, told me how successful he is. My gut told me walk away. But because I had a commitment of 4.5, I actually did not listen to my gut, and I took that guy's money, and he played truant with me and actually destroyed the company. So please, and I've been hearing this from Shibam also, trust your gut, do not show desperation, and do not get into a game of unequals because you're bound to lose. The last and most important thing is, please understand color of money. Take money, do your homework on the individual, that as much as he does diligence, you must do diligence on the investor to find out, has he invested? In fact, most startups don't even ask investor questions. Where have you invested? Can I talk to some of the companies you invested in? What is the value you can bring to my startup? So don't raise money in desperation. Don't raise money because you're running out of money in the next 30 days. Raise money when you have a fairly good pipeline. These are some of my own things.
Right. Rakesh, can I just add across? I'd written a very nice blog, what John said, just to support across. Just a second, I'll just share one screenshot, and I think that would give a lot of insights. Let me just try to share across.
Thanks, John, for sharing your personal experience as well. I think that is what really counts. Being an investor and an entrepreneur really brings in a lot of insight and understand where the entrepreneur goes through and can be empathetic to them.
So this is the screen which I would like to share across, Rakesh. This is a blog for first-time entrepreneurs who are looking to raise the first check, right? And this is purely sending out online, on an email pitch. How would you try to, work across? This is a good, lesson in terms of keeping across how this whole, email pitching should be done across, right? So I would recommend founders read this down. This would be quite interesting for you to look at it. That's it.
In fact, Sanjay, I want to add something here. One of the founders who we were mentoring, this 20 lakh deal, the promoter came to me and said, you don't understand what shit I'm in, man. I need that damn money. And he's on this webinar. And I told him, listen, for God's sake, do not screw up your long term by being short-sighted. Delay it by 2 months. Do not hire people. No, man, if I don't hire people, I will lose time. So I like the paranoia of this founder, but I hated his desperation. And took him out for a drink, got him fairly sloshed, told him, boss, take it easy, kuch hona nahi hai. Worst case, and this is something I tell startups and founders, worst case, what will happen? You will die. You will shut. But look at the experience of the learnings from your mistakes. You will emerge stronger. So do not screw up your long term for the short term.
No, agreed. And I've seen across, founders making their deals stale by doing a broadcast. And I receive so many emails with saying that, hi, hello. And there's not even a personalization. There's no human touch, right? They just broadcast it and make their deal stale. And that shows a lot of desperation in, going across. And rightfully so, having a great mentor. So, for example, as Shibam got incubated at SINE, definitely that would have added a lot of value to his journey and making him investable. So, get some initial validation done across, like how SINE would do across, or possibly we at 100X, right? We are not a big check writer, but when we invest, there is definitely an interest from VCs saying that all the validation or the checks have been passed across, right? So that's how it is. We have got a couple of questions, John, here, which has been popping up. So let's start getting into those questions, if we will be working across. So one second, I'll just pick up one of the questions, and John, you may want to take it for an early stage edutech startup, POC, pre-value. What are the things investor and SINE will look for investing? Shibam, you may want to take. We have Rakesh back. So this is a question which we are trying to look at. Rakesh.
Yeah. So for an early stage edutech startup, okay, pre-seed and well. So one thing we look at is the team at the stage, right? Whether they are full time. We've seen startups who are either working somewhere else, and then they said, when I get the funding, I would join in full time. That is something which you say that if you want to take the plunge, an entrepreneur is somebody who is a risk taker, and an incubation center takes an equal risk by investing in companies that we believe in. So when we mentor or when we interact with a startup, one thing we look first is the team. Do they have complementary skill set? Most often we see team members who are having all of them technical backgrounds. We see if somebody with a business background, somebody who has a failed entrepreneur, or somebody who is done and probably didn't work out. That brings a lot of learning. So I think we look holistically on the team. Second is in terms of the market. How big is the opportunity? What problem is he solving? In the edutech business, with the current situation, there has been an increase in the uptake of a lot of teachings which is online. So the market, it's a growing market. Third, we see in terms of what is the moat, as Sanjay mentioned. What is the the differentiator or the unfair advantage that the startup has. And then, being a technology incubation center, we also validate a lot on the technology. Is that something that would be different from the competition? Have they done a good competitive study? Do they understand? Very often, what we see is, who is your competition? They say no competition, right? And as a team, when we look at it, when we do a Google search, we find at least few other startups who are doing very similar things. So understanding whether the startup has done their homework, whether he or she is full time, and whether it is a good opportunity to invest in, is something at an early stage that we look at. It's difficult to see revenues coming in at that stage because you're just starting up. But is that an opportunity? And and these are the few things that definitely we would look at while engaging with the startup.
So Rakesh, you had some pre-scheduled, you had collected some questions. I think we should close that. We are at 47 minutes already.
Right. So I put it under a few buckets, and one of which is, I think 30% of the people who have asked is how has things changed with the current situation, right? With the lockdown and the uncertainty that is looming. How or what are the areas which are which are going to be of interest to investors, number one, and startups? What domains of startup would be more exciting, more hot? And how do investors look at this? Are they taking a step back and focusing on their portfolio, or are they? They do have. Some of the investors say that they have dry powder, but are they willing to invest in new companies, or are they wanting to take a step back and see how things are?
So we ran across a survey which is called 100X Outlook Sentiment Survey, which is available for download, which gives a lot of these insights about what VCs are thinking, what investors, family offices, angels are thinking, and what is the founder sentiment. So do download it from the 100X website. The focus, what we are observing in my interaction with various VCs, and our belief at 100X equally, was when we started hearing about the COVID crisis. The first thing what as any investor would do across is find a place where you can pause and try to evaluate whether how what is the depth of this crisis, right? And we want to first secure across my first right on my resources is with my portfolio company. So where I've invested, I'm committed to them first. So we started engaging with my portfolio companies closely, trying to see across if there were opportunities also which got created within this COVID for a couple of startups. So how do you use capital efficiently for growth, right? And what we observed across was one, when we started looking is the cost of customer acquisition will go down drastically. This is the best time to acquire customers, right? Your adoption or acceleration on, adoption of technology with consumers is unprecedented, right? People who have never logged into a video conferencing or a Zoom have learned across. Even 60 years plus are logging into Zoom very comfortably. So adoption is changed. We saw across a huge opportunity bringing up in home economy, saying that any journey which starts across at home is going to be very, very fruitful. So how do you bring everything which was available either physically at home or virtually at home, right? Be it across online training, be it across on education. So all this journey has to begin across at home, right? With no touch or zero touch, right? So more businesses which pivoted into that kind of model. That's what we were working across with our portfolio companies. For the newer investments, we wanted to have our, so we run at 100x classes as a batch of companies. So we had our class one companies showcased in December, where we had 20 odd companies where we invested. We wanted to do our class two in April 2020. Now it has been pushed across to July. So our investment for class two is open, and every VC has got enough dry powder to invest. And we believe investing in these times is far more valuable in terms of your returns. When there is crisis and you find founders who are able to mitigate this crisis and come out stronger, are going to be much more capital efficient. These are the times when talent will be available cheap. This is the time you have to really build the company, right? And we are very, very fortunate to see across these times, and I have been part of two crises. One is the dot-com one, where I personally was an entrepreneur and saw that crisis in the dot-com times. And then we saw across 2008-9 the financial crisis. In both the crises, things, anybody who started businesses and stuck to it came out much stronger and emerged much stronger. So this is one more crisis which has come across, and we will go through this. And we believe that we will invest, and all VCs will continue investing in startups.
Right. Thanks, Sanjay, for that perspective. Other question that we received is in terms of approach to valuation. This has been a question, right from early stage to mid stage. I was speaking with some of the other startups at SINE, and they feel that at the early stage it's more art than science, and then when it comes to some amount of revenue, you try to the art kind of changes into a little bit of science and maths, but how should they approach evaluation? Maybe a take from all of you would be helpful. According to you, what would be, most often it's a middle ground. The investor says a particular value, and they would have a particular range or something in mind, and the entrepreneurs also something they might just pull it out of the air, or sometimes they might have thought through. But how do you kind of reach the middle ground is something which often baffles entrepreneurs at an early to a middle stage. So, your take on valuations. I'll start with John.
Okay, so like I said, any startup journey with a VC or an investor partner has to be a win-win. Now, I've seen startup founders with these fancy degrees from fancy colleges believe that the sun shines from their backside, and they believe that because of that degree, they have the right to ask what they want. But they forget that, and like Sanjay alluded to, that investors are also looking at returns. Yeah. So if you have to be sure that you don't give an arm and a leg to raise the money, and the investor also must be given the option to make handsome returns, because he's taking very, very early bets on you when nobody wanted to. So I think, and the rule of thumb is, if somebody is asking for 2 crores for a startup, and it's very, very early stage, and I'm saying all other check boxes tick, where markets are good, promoters are good, opportunity is good, the moat is good, everything, then most early stage investors would want a between 15 to 20% equity in that startup. And then, like I think Shibam mentioned, there will be a negotiation and the middle ground. And most good investors, when they see good potential and promising startups with founders who got their head screwed on right, will see that. And I think the middle ground would be somewhere in between. This company is asking for obscene valuations. Those days are gone. People, and even today I have guys who come and say, but when Google started, they had nothing. When Facebook started, that was 20 years back. Those were different times. India in 2000, I did my first startup, didn't have this word VC. We had one company called Jumpstart, and the US market has taken 50 years to evolve to this level. So there's days of just taking a sheet of paper and approaching. Those days are gone. So be realistic, be practical. Also understand that a partnership which is a win-lose for either a founder or an investor is a lose-lose. It has to be win-win, and go with your gut. If you like, and I think Sanjay, you invest a lot initially on gut. I've invested a lot on gut. Use your gut efficiently, and do not be on a journey of unequals. It's a win-win partnership. It's a partnership, especially for investors who are coming and taking early bets on you.
Thanks, John. Shibam, so your take on valuation, especially early stage, some of the, I think the investment that you took was on a convertible, right? And so that was I don't know. You share your I don't want to kind of go ahead in terms of how did you approach valuation? It was more art at that time, and how things have changed when you have raised your the next round.
Right. So I completely agree with John. In the early days, valuation, there is no science, right? What I've seen is that most of the investors, whether angel or seed, or let's say like pre-series A, they have some numbers in mind. So let's say they have a range, 15 to 20%, 10 to 15%, 10 to 12%. And they have a quantum in mind. So let's say for 10 to 12%, I will invest 1 crore, 1.5 crore, 1.3 crore, whatever the number is, right? So they will not deviate from that range. What best you can do is that, and most of the time, what they'll offer you is in the lower bracket. So the best you can go in the upper bracket. So let's say if they have offered you 15%, max you can go 18, 19%. Or if they're very particular about 20%, then maybe you can just negotiate on the quantum, and that will again increase your valuation. So that is one approach at the very early stage. There is absolutely no science, nothing you can do it. Now, once you raise, let's say early stage 1 crore, 1.5 to 3 crore, then you have some thesis or some milestones to achieve in the next round, right? It can be revenue, it can be product, it can be certain assumptions of your balance sheet that you want to prove. So when you go to the next round of raising fund, so let's say in our case, we raised pre-series after 1 crore of fund, right? So we try to discuss on those terms, right? That see, look, like 1 year back, we are at this stage. Now we have reached this stage. Now our product is more proven, our GTM is more proven, or whatever the number is, right? And hence our valuation ask is this much. Again, they will have similar kind of things, right? Because the number is still not that proven. It is not that big size that you can relate with your revenue multiple or EBITDA multiple. So in that case also, they will have again this range, 20-25% range, and the quantum you can negotiate, and you can probably agree on a middle ground valuation. In this scenario, if you have one more competitor investor, then your valuation can go up and down. So we have seen in the third round where our valuation actually jumped almost 2x in a matter of 4 days, right? So let's say the first offer we got at X on Monday, by Friday it was 2x, because we have 3-4 investors wanted to invest in us, right? Now whether X was right, 2x was right, there is no argument around it. There is no science around it. But I believe it should not be like too much, because for example, if you look at, let's say, WeWork, Yesco, or let's say some highly valued organization, if you raise on too much valuation, you'll also have to justify those valuation, right? You have to keep on justifying those valuations. So you should know your market limitation, your market size limitation, etc., and that's how it goes. While raising capital, we also raise certain bridge rounds or certain rounds where we couldn't agree on the valuation at all, right? So our expectation is X, their expectation is Y, and there is no middle ground at all. So in that case, what we do is that we link it to the future round. We say, okay, fine, I don't know what the valuation, you don't know what the valuation, and most of the time it is like internal round where your internal investor want to put in more money. So then you say, okay, whatever that is, I will raise my next round with certain cap and floor in certain time period, and whatever I raise, I will give you 25-30% discount. And again, there is a range, 25-30% discount. If someone asking 70%, 80%, then that means he's not the right kind of investor. So everything is pretty much standard. There is a range, there is a quantum. You just can try to be at the upper end. And if you're lucky, if you have 3-4 investors sitting at the same point of time, then maybe your valuation will jump up to 1.5, 1.2x over a period of time. But again, you should not like go up for like too much valuation, because investors are also expecting some returns, and more higher the valuation, lesser is the stake and lesser the IRR. So that will be, I think, my 2 cents on this.
Thanks, Shibam. So Sanjay, with 100X.VC, you've come up with iSafe notes. That is a convertible India a simple agreement for future equity. That is. Can you give a take on valuation? Also, a little bit explain what iSafe is.
Sure. So basically, this discussion was quite a lot happening when I was an angel investor, and there was very difficult times when most of the deals would break at valuations because founders would not know how to value their company and will ask across, or they feel they are entitled basis on the numbers which are happening in the market overseas, right? They will put a benchmark. This deal is happening in US, very similar. They were valued at this number, so they are entitled. So there were these challenges which we saw across. The simplest solution to that we saw across was India's simple agreement for future equity, whereby you defer this valuation discussion to a later stage. What you do right now is, I like the company, you want to take money from me, I invest into you, let's sign a convertible note. Whenever you grow across and do a price round, whenever some valuation happens with the bigger VCs and you are able to raise the round, you give me the equity for the money which I have invested. And there can be multiple ways of doing it. So we invested in 20 startups using iSafe. And now the impact, because we created iSafe as an open source document which anybody can freely use it, we have seen over 100 plus startups who have raised their money now, their first check using iSafe. And in fact, within my portfolio of 100X, 9 companies have raised money through iSafe as a follow-on round even. So it's like trying to build the company. You are not focused on valuation. You say that, okay, I assure you, guarantee that I will give you equity because you have given me money. That's as simple as that. It's just an agreement. Now, at what quantum, how it will happen across, will be decided across whenever they raise the price round or a larger round when VC comes at Series A. An advantage with iSafe, because it's a founder-friendly document, there are no board seats, there are no rights given to any investor. So founders are free. There is no requirement of creation of ESOP pool. So it's a very simple 6-page document, no legal fees. It's a standard template. No lawyers get involved. You just sign over the counter. And for founders, if they use iSafe, let's assume there are 4 investors who want to invest in the company. You can, as a founder, you issue that safe note to individually those 4 investors. So let's say one person is going to maybe take around a month to wire the money. That's okay. You start receiving money from individual investors and you can start working on your business, right? You don't have, whether it's in shareholder agreement, in a price round, you need to have all the investors to sign that one document. And then there is a compliance, then you get all the MCS stuff done, issue shares. This is a very simple way and it's open source. So I welcome anybody who is in seed stage startup ecosystem to go 100X.VC website and download iSafe and raise their first check. In fact, first, second check, up till you raise a Series A, you can actually raise your money using Safe. And it's a very popular document in Silicon Valley. It's just that in India, this was not being used across, and it was very tough for early stage founders to raise money. So I believe this is a great impact which 100X has created using iSafe as an open source document.
Thanks, Sanjay. I think we overshot by 4 minutes, but we see other questions as well. But if you have any queries, you can reach out to us. You can reach out to 100X. Sanjay, could you share your email ID if they want to reach out to send any pitch?
Sure. So in case you want to reach out to 100X, it is pitch@100X.VC. So we welcome investment proposal at pitch@100X.VC. We are looking across to invest in another batch of companies. The class 2 investment applications are open.
Thank you. And John, if any of the startups would like to approach you, they can probably catch up with you on LinkedIn, John Kuruvilla.
Yep. Or they can drop me a mail at john@kalpnik.com.
Right. And Shibam, yeah, John at K. Can we have that on the ribbon, please? The email addresses.
KALPNIK.com.
Thank you. And
no A. KALPNIK.
Yeah.
Yeah. I mean, of course, they can directly reach out to me on email. So my email ID is Shibam, SHIB for Bombay, AM @atomberg.com, Atomberg.com.
Right, and just wait for that to come up on the screen. It's Shibam@atomberg.com.
Correct.
Right. Well, thank you so much, Sanjay, John, Shibam, for this wonderful webinar, and it's been a pleasure, speaking to all of you. And I've made my notes, and this was a great learning for me. And I want to thank our audience as well, for being so active with the questions. As I said, you can reach out to all 4 of us, the different email addresses that we provide. And if you are looking at early stage funding, in the sense that a prototype funding, I saw one of the questions, you can reach out to SINE at bd@sineiitb.org. And once again, thank you so much for joining, and wish you a very good day ahead.
Thank you, Rakesh. Thank you, John. Thank you, Shibam.
Thanks, Sanjay. Thanks, Shibam. Thanks, Rakesh. Stay safe, guys.
Yeah.
Bye.